Welcome to the Providence Quarterly Investment Update for July 2021. I'm Michael Ogg and I'm here with Grant Patterson, CIO and founder of Providence. As you can see, Grant and I are currently in lockdown, so this quarterly is a webinar. Grant, how are things at home?
It's okay, thanks, Mike. I think second time around, it's tougher. I've been talking to a number of people around in the business community, and for some reason, the second time around here in Sydney, and we know our friends in Melbourne had a very big lockdown. Second time around's a little bit more difficult, so a little bit more challenging. So we're just keeping an eye on all the team. All the team are working really well from home. Got any support that they need. But I just think it's a challenging period of time. We're able to continue to do our work for our clients. It just takes longer. It's more clunky. It's more difficult, and we miss the interaction with all the team. But generally, all's safe and all's well, and we can't complain in regards to a service industry that our business can continue. We feel for those small businesses that are really struggling.
It's been quite an amazing 12 months. I mean, quite a rebound in markets and asset prices, what have you. What are your observations of the last 12 months, Grant?
Well, certainly the first observation is the performance of portfolios and by asset markets has been extraordinary. I mean, given the disruption that we had over the last 12 months and the uncertainty, asset prices and asset classes across all assets have performed exceptionally well. So, we're pleased that the portfolios have done so well for the 12 months ended June 30. We're surprised by how strong asset prices have been, but I guess, which we'll talk later, when you've got free money and central banks and governments throwing money at you, markets can perform well. I think the other thing during the last 12 months is the irrational behaviour in certain areas of the markets. I mean, there's been some extraordinary moves in regards to some stocks or some sectors, driven by some of the retail, platforms, if you like. So whether it be, me stocks or cryptos or all sorts of things, there's been some really irrational behaviour. And valuations have continued to be supported by a very low bond rate. And I'm surprised by how resilient valuations are. But overall, a very good 12 months, despite being very diversified. Portfolios have done exceptionally well.
Grant, one of your headlines I read recently was that we're in the hands of the central banks. What exactly did you mean by that?
Well, I know that central banks have been, supportive, obviously, of asset markets and investment markets and the economy combined with the government. So you've now got central banks and the government interdependent on each other, supporting each other to try and support the economy during this dislocation. But what's happened is that, markets now and financial assets have become too big to fail. The economy is really driven by financial assets. So created by the central banks that have been providing free liquidity to the markets. And it's become pretty difficult now, whereby very difficult for the central banks to just taper too quickly, because the investment markets will not like that, particularly if bond rates go up, and therefore that will cause problems down the track. So it really is that we are in the hands of the central banks about how quickly they taper, how quickly they normalise policy. The economy, in a sense, doesn't matter until it reacts to what the central banks are doing. So certainly the central banks are really what we're watching as to how they, and if they can, unwind their policy.
And Grant, something else that we're watching is inflation. And, every newspaper and every article I read now has some inflation theme to it. But there does seem to be some disconnect between inflation and inflation expectations and the bond market. Can you just explain what's going on here?
Well, I wish I could, because I don't know. But what's actually happening is that core inflation, particularly in the States, has spiked recently to very high levels. And that's really been driven by the lack of inventory in the system and supply bottlenecks. So the inflation number in the States is much higher than what the market or the Fed have been anticipating. But the commentary is it's transitory. It's because of one-off events, and it will come back. Now, there's a lot of debate about whether that's right or wrong, and one of our members on the investment committee, Jonathan Payne, is cautioning about some lags that are yet to come through on inflation, particularly in the housing market. So you've seen the CPI very, very strong bounce up, yet the bond market, which would normally increase in yields, given the strong growth outlook and the inflation outlook, has actually been declining and coming back. And so that's caused a lot of sort of consternation, if you like, in markets. The way we read it is that the bond market is concerned that as the central banks unwind policy, that longer term growth is going to be challenged because of valuations. So the bond yield, the 10-year bond yield, is looking through this short period of transitory inflation, whatever that means. And I haven't yet seen anyone to define what transitory means as in a time frame. But the bond market is concerned about longer term growth. Yet equity markets and valuations are presuming growth will be very strong for a long period of time, and there are some inflationary pressures. So all we're pointing to there is a disconnect from what we're used to in regards to bond rates and inflation.
So Grant, that's probably a good segue into your view on global growth and asset prices. So what is the current outlook for global growth and asset prices?
Well, global growth's been very strong in the economies that have, got the vaccination rollout and started to get back to whatever normal is. So China and the US in particular had very, very strong growth over the last couple of quarters, exceptionally strong, to be honest. Now, we've probably seen the peak in growth, we think, in those two economies. And so there's some risk to future corporate earnings. But growth looks pretty strong once the vaccination rollout comes through. So in an environment where growth is strong, the central banks are only going to take baby steps in normalising policy, and interest rates are going to stay quite low, then in that sort of environment, risk assets and equities are probably reasonably well supported in the short term.
Grant, there also seems to be a huge amount of investment products coming across the desk. Where are you seeing the opportunities at the moment?
Well, there's no shortage of product, Mike. I can't believe the amount of product that's coming past our desk on a daily basis. And we try and, review most of the stuff that comes through to see if it may suit our portfolios. And so it's really important now to understand you can't have every lolly in the lolly jar and differentiate between, the quality and the not so. And I think it's really important to think about what the environment looks like in 3 years' time, not what it looks like today. But in regards to the opportunities that we see, we're quite attracted to the loan market, first mortgage, fully secured property loans, or senior secured loans to Australian corporates. We think you're getting paid for the risks that you're undertaking there, receiving around about 6 to 7.5% income, not too aggressive gearing, and backed by the assets. So that's a nice space, we think, to boost your income in the portfolios when cash is in real rates is negative. In some of the niche property sectors, we still quite like the specialist disability housing sector. We think is a thematic that's going to grow in Australia for some time. And so we quite like that area. Regional hospitality, which we've mentioned quite a few times. We think there's some good opportunities there. And also in infrastructure, global infrastructure, given the amount of fiscal stimulus by governments that are going to start building roads and tunnels and all sorts of infrastructure. So they're probably the three areas that we think are a little bit different in regards to the traditional area, but we think can provide a good risk-adjusted return, and we are deploying capital for our clients in those areas.
And given all that, what's the current stance of the investment committee, and how do you see asset allocation in 12 months' time?
Oh, I don't know where asset allocation is going to be in 12 months' time because I don't know what the next 3 months looks like. But the stance that we've got in the investment committee, with the focus on the protection and preservation of capital and understanding the very strong returns we've had over the last couple of years despite COVID, is to be humble and make sure that you've got plenty of diversity in the portfolio. I think diversification is the number one thing to protect your capital over the next 3 years, whether we're in inflationary, stagflationary, deflationary environment, whether we get a second or third variant in COVID. I think it's really important to remain diversified in your portfolios and focus on value. So if we do get a correction in markets, be careful not to chase the herd, be careful not to be in the hot stocks, if you like, and therefore your portfolios will be able to withstand, if you like, an event in markets. And in the meantime, I think returns from portfolios can be pretty solid, particularly against cash, and that's the stance that we're staying with.
And Grant, given that it's such an unusual time, how does it rate compared to what you've seen over the last 20 years?
Well, it's certainly the most challenging environment that I've seen in 40 years of being in markets. And, when you talk to people who've been in the markets for a long time, there's a fair bit of humility in the commentary is that we just don't know. I mean, it is really different this time. Now, the result may be the same in regards to valuations, but it's very difficult because the nexus is broken somewhat by the impact of the central banks and the government and the interdependence of the two. So I'd have to say, in regards to custodian of clients' wealth, it is very difficult, and we're spending a lot of time trying to understand what the outcome could be. I mean, there's plenty of worries, and I always worry about issues. I mean, in credit, you're really not being paid for the risk you're taking, in our view. Corporate debt is very high, and the covenants are very light. So we'd be very careful of credit. There's a lot of complacency, as I mentioned before, in regards to certain assets and momentum in the herd. And there's still an unfettered view on inflation. We still don't know whether inflation is going to be transitory or not. So I wouldn't want to make a very strong case one way or the other. So as we mentioned, diversified, being valued based, but there are thematics that are coming through. And so where our asset allocation for portfolios might be in 3 or 5 years' time, I'm sure they'll be a lot different. The thematics that we're watching are carbon capture, how to play that theme around the globe. Automation is a very big key across all corporates, and also infrastructure, as I mentioned before. So I think the portfolio will remain quite diversified for a long period of time across those thematics, rather than just how much you have in equities and how much you have in bonds.
Thank you for that. And Grant, before we leave, is there any update in Providence you'd like to share with us?
Well, there's always plenty going on, Mike. First of all, very proud of the team that Providence is now certified as carbon neutral. I think it's part of our commitment to our future generations to make sure that we play our small part in that, and we're now certified as carbon neutral. We do have a new staff member, Will Shen, who's joined us to work on the research side, replacing Harry. The custodian transfer is being moved across all clients, and I know that that's taking a lot of time for all of our admin staff and our implementation staff. So a lot going on in that area, which we believe will give our clients more security and more efficiency. And also, we've just in recognising Will Porter's input into the investment committee and assisting me in regards to the investment decision making. Will has now been promoted to head of investment strategy, and I'm thrilled to have him assisting me in regards to the CIO function.
Well, Grant, as always, thank you very much. I always enjoy hearing your views. I think it sounds like it's going to be a very interesting couple of months ahead of us.
Yeah, well, thanks, Mike. I think, for everyone out there, we do miss being in person, but, take care. I think it's tougher this second time around, but we'll continue to, be vigilant in regards to what's happening in markets, and we just look forward to getting back together, hopefully for the 21st birthday celebrations.
Absolutely. Well, thanks all for watching. I hope you found the webinar of interest. And if you do have any questions or any queries, please don't hesitate calling Grant, myself, or any of the Providence team. Stay safe, and we'll see you next time. Thank you.
For a full report of our outlook, please see our website.